Well, this is an analysis on gold, and it will be an analysis, an over the surface analysis. It won't be an in-depth analysis. So I'll try to keep it simple and concise. So just for to start correctly, this is the weekly time frame, and as you can see, the trend is clearly bullish. So I wouldn't be looking to sell if I am a swing trader. Definitely not. I would be looking to buy, and I would be looking to buy at discount pricing. So let's dive into this. First of all, let's make this. Okay. So for starters, with the surface, with this on central banks. Central banks are buying a lot of gold. That's for starters. Bullish trend. Bullish. The USD is what is we can read here. Quantitative. So a quick, very quick over the surface analysis. So the trend is bullish. Central banks are accumulating a lot of gold. If they're accumulating gold, in a way, why wouldn't you? I mean, it's a hedge against inflation, right? So, yeah, I mean, if you buy gold, essentially you are on the right side of the game. So, bullish trend, the DXY, the US dollar, is weakening every year. As you can see right here, it's weakening. And for example, if I put, just as an example, if I put the dollar against the Swiss franc, let's look at this. Look at how the dollar each year is essentially worthless every single year. Every single year. Look at that. So let's go back to gold. This was just an example. As you can see, the here's how gold is appreciating against the dollar. So let's end this and dive deep into the charts. So on the weekly time frame, as you can see, from all-time highs, which was on this candle, yeah, from this candle to this low, it dropped an 11.30%, and that was a pullback. Essentially, when someone is looking to buy inside a pullback, the ideal way of doing it is below the 50% of the pullback, once the pullback is, in anyone's opinion, done. So right now, for example, price is below the 50% level, as you can see in here, and price started to go to the upside, as you can see. So from this low now, from this low to this high, price went below the 50% level, which is the discount of the impulse of gold. As you can see, price went below the 50%, which is this line, and tapped into a very relevant price range. A very relevant price range. So essentially, why is this price range important? Well, for starters, it is below the 50% of the daily range, of the daily impulse from low to high. And okay, yeah, it's below the 50%, which means that price was a discount. So essentially, what you want to do is to buy at a discount pricing, obviously, because you're looking to make capital gains. You're looking to buy lower, sell higher, right? So price tapped into this relevant price range and started to go to the upside. Plus, price swept sell liquidity. What does that mean? This is also sell liquidity, and this is also sell liquidity. Let me get it straight. If you start to buy, for example, in here, you start to buy in here, in here, in here, in here, it retraces, you buy in here. Essentially, what books and courses teach to retail traders, or to, well, I mean, almost every course teaches that, it is to put your stop loss below the last high, I'm sorry, below the last higher low, which is below here. Essentially, price breaks structure right here, well, it breaks here, boom, stop loss right here below. Then price breaks the structure, boom, stop loss below. So stop losses, stop losses. Price drops, and it sweeps sell side liquidity. A lot of stop losses are liquidated in here. Then price taps into a relevant price range in here. Price starts to go to the upside. Stop losses in here, and boom, liquidated. These stop losses get liquidated, and these stop losses get liquidated too. So a lot of sell side liquidity has been swept. Essentially, price went into discount pricing, price tapped into a relevant price range, and started to go to the upside. Now, if I go to the 15, right here it was a 4-hour time frame, but if I go to the 15-minute time frame, we can see how price is actually, well, moving to the upside. But, and I am not going to explain in depth what this means, these levels exactly mean, but I am anticipating a move to the downside. A lot of people, for example, would seek to buy in here when price is moving to the upside, and while it perfectly can from here move to the upside, like, you know, it perfectly can do that, but it's very probable that from this area, for example, price goes to the downside, and I would look to buy in at better prices. I would essentially look to buy around this area, because also inside this relevant price range, sell side liquidity was swept with this candle. So yeah, essentially that's what I would be anticipating, and it is very probable that price actually go to the upside from this price range to this high, and eventually to these equal highs. So above these highs, these relative equal highs, there's a lot of buy side liquidity, which means that a lot of people might be anticipating that gold prices are going to go lower, which it also can happen, and they put their stop losses above in here, so above these highs. So there's a lot of liquidity above, residing above these highs. So I am definitely anticipating that price eventually will reach these highs. Also considering, I mean, and this is only the price action part, also considering the fundamentals, which is that central banks are accumulating gold, that interest rates are going to get cut more eventually, probably in December, let's see. And I mean, quantitative easing, I'm sorry, the quantitative tightening is going to end in December, so I am definitely anticipating higher prices for gold, unless a black swan happens or something extremely major happens in the world. But yeah, I can very easily see this happening, and it's just a matter of time to see what happens. As I said, like I said, this was not an in-depth analysis, it was an over the surface analysis, but that's what I'm anticipating for gold.